If you're on SSDI and you're worried about taxes for 2025, take a deep breath. This video is going to explain everything in plain English. No legalese, no confusion, and no fear. And before we start, a quick but important reminder. Everyone's situation is different. Your filing status, your spouse's income, and any extra earnings all matter. This video explains the general rules so you can understand the basics, but it's not personal tax advice. If you have a complicated situation, talk to a tax professional. All right, let's make this simple. First question, does SSDI count as taxable income? Here's the easiest way to understand it. Your SSDI can be taxable, but usually only if you have other income on top of it. That might be work income, self-employment income, a spouse's income, investment income, retirement benefits, or anything else the IRS considers taxable income. If SSDI is your only income, generally your benefits are not taxable, and many people in that situation don't end up owing federal income tax at all. 2. How the IRS decides if your SSDI is taxable. This is the part that confuses everyone, so let's break it down. The IRS uses something called combined income. Combined income is your adjusted gross income plus half of your SSDI plus any tax-exempt interest. You do not have to calculate this yourself by hand. Tax software and preparers do it for you. This video is just helping you understand the formula so you're not blindsided later. 3. The income limits for 2025. The IRS sets income thresholds that decide when your Social Security benefits, including SSDI, may become taxable. Here's the simple version. If you file single or head of household, your SSDI can become taxable if your combined income is over $25,000. If you're married filing jointly, your SSDI can become taxable if your combined income is over $32,000. Below those amounts, none of your benefits are taxable. Between the middle ranges, up to 50% of your benefits can be taxable. Above the higher ranges, up to 85% of your benefits can be taxable. Not 85% tax, just 85% of the benefit is counted as taxable income. We'll talk more about that in a minute. First, let's do quick, simple examples so you can see how this works. Example number 1. Let's say someone is a single filer, and that person receives $18,000 per year in SSDI. Half of that is $9,000. If you earn no other income, your combined income is $9,000. That's under $25,000. So in that example, none of your SSDI is taxable. Now let's say you earn $10,000 from part-time work. Your combined income becomes $10,000 from work plus $9,000, which is half your SSDI, for a total of $19,000. That's still below the $25,000 threshold, so in that example, your SSDI still wouldn't be taxable. This is why a lot of people can earn some money and still not owe taxes on their SSDI. 5. Example number 2, married filing jointly. Now let's look at a married couple filing jointly. Let's say you receive $20,000 in SSDI. Half of that is $10,000. If your spouse earns $25,000, your combined income is $25,000 from your spouse plus $10,000, which is half your SSDI, for a total of $35,000. That's above the $32,000 base amount for married filing jointly. So in that situation, some of your SSDI may be taxable. Not all of it, just a portion. Exactly how much depends on your full return, deductions, and other income. Every household is different, which is why everyone's situation is different. Your filing status, your spouse's income, and any extra earnings all matter. If you're unsure where you fall, talk to a tax professional. 6. How much of your SSDI can be taxed? Here's the simple version of the IRS rules. 0% of your benefits are taxable if you're under the base threshold. Up to 50% of your benefits can be taxable if you're in the middle range. Up to 85% of your benefits can be taxable if you're in the high range. Benefits can be taxable if you're above the higher range. It's important to note that this does not mean the government takes 85% of your check. It means that up to 85% of your benefit is treated as taxable income, and then normal tax rates apply to that portion, just like any other income. For many people, the actual tax owed ends up being much smaller than the scary 85% number sounds. 7. If you work while on SSDI, how does that affect taxes? A lot of people ask, if I work while on SSDI, will I owe taxes? Here's the simple truth. If your combined income stays below the threshold for your filing status, often you will owe no tax on your SSDI. If your work income pushes your combined income above those thresholds, then some of your benefits may become taxable. But even then, that doesn't automatically mean a huge tax bill. It just depends on your total numbers, your work income, your benefits, your deductions, and your filing status. 8. What if you earn under $600? If you freelance or do gig work and earn under $600 from a company, they might not send you a 1099 form. But here's the key point. That income is still taxable. The IRS expects you to report all income even if you never get a form in the mail. Even small amounts of income count toward your combined income for Social Security taxation. It's just something to keep in mind so you're not surprised later. 9. It's also important to know about 1099 work and self-employment taxes. Now let's talk about something that catches a lot of people off guard, especially people on SSDI who do part-time work and get a 1099 form in the mail. When you're paid on a 1099, the IRS usually treats you as self-employed. That means you may have to pay regular income tax plus self-employment tax. Self-employment tax covers Social Security and Medicare. For most people, it's around 15.3% of your net self-employment earnings, on top of any income tax. And if your net earnings from self-employment are $400 or more for the year, you generally have to file Schedule SE and pay that self-employment tax. A lot of people don't realize this, and they get hit with a big tax bill at the end of the year and have to go on a payment plan. So if you or your spouse are doing cleaning jobs, gig work, deliveries, online work, or anything else where you're paid with a 1099, it's really important to keep track of what you earn, track your business expenses, and if possible, set aside some money for taxes so you're not blindsided. Again, everyone's situation is different. This is general information so you understand the basics. For specific numbers, a tax professional can walk through it with you. 10. What if all your extra income is from self-employment? Self-employment is allowed while you're on SSDI, but it comes with 2 layers to think about. The IRS side for taxes, the Social Security side for your disability benefits. On the IRS side, all of your net self-employment income is generally taxable. If you have at least $400 in net earnings, you may owe self-employment tax in addition to regular income tax. On the Social Security side, SSDI looks at how much you're earning, how many hours you're working, and whether your self-employment shows that you're performing substantial gainful activity. That's separate from taxes, but it's why self-employment can be more complicated than a simple W-2 job. You won't lose your SSDI just because you owe taxes. Those are 2 different systems, but both your income and your work activity matter. If all of your extra income is self-employment, it is really worth getting advice from a tax professional or a benefits counselor who understands SSDI rules, so you can avoid surprises on both sides. 11. Does filing taxes affect your SSDI benefits? This is a big fear, so let's clear it up. Filing a tax return does not make you lose your SSDI benefits. Owing federal income tax does not make you lose your SSDI benefits. SSDI is not income-based in the same way that SSI is. The only way your work affects SSDI is through the Social Security work rules, like substantial gainful activity, trial work period rules, and your reporting requirements to Social Security. Taxes are handled by the IRS. Benefits are handled by Social Security. They interact sometimes, but they are not the same thing. 12. When should you talk to a tax professional? A quick call or visit with a tax professional is usually worth it if you're married and your spouse earns income, you worked part of the year, you had self-employment or 1099 income, you received a large SSDI back pay lump sum, you were overpaid by Social Security, or you just want help planning ahead so you don't get a surprise bill next year. A tax professional can look at your actual numbers and give guidance tailored to you, which this video can't do. 13. Final thoughts. Taxes are stressful for everyone, especially when you're on SSDI and you're afraid of doing something wrong or losing your benefits. But once you understand the basic rules, it becomes a lot less scary. And remember, everyone's situation is different. Your filing status, your spouse's income, and any extra earnings all matter. This video was just the plain English breakdown so you can understand the general guidelines. You're doing great. You're not alone, and you don't have to navigate all of this in fear. If this helped you, feel free to subscribe. I've got more clear, simple, realistic videos coming to help you feel empowered, not overwhelmed.